Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will talk about the improving Bitcoin overnight seasonality strategy.
Hello, my name is Radovan Vojtko. I'm CEO and Head of Research at Quantpedia. Today we will discuss once again cryptocurrency trading strategy. Our interest is in seasonality strategies. We have a lot of those strategies in our database, so feel free to look out and search for interesting seasonality strategy in our Quantpedia database. So here we go. Seasonality of Bitcoin. The seasonality effects are very interesting. The main reason for that is because they are driven by other factors than general market trends. Those effects usually don't correlate strongly with the market movements, which means that it can help us to reduce the portfolio's overall risk if you use some seasonality effects. We have another research article, the previous one. It's called Are There Seasonal Intraday or Overnight Anomalies in Bitcoin? I also invite you to see this previous article. The new article, The Seasonality of Bitcoin, which was published 2 days ago, 14 September 2023. It goes more into depth into these seasonal anomalies related to Bitcoin. So it builds on top of the previous article, which is nearly 1.5 years old. We have more findings, etc. If you are more interested, or if you are interested in more cryptocurrency research articles, then you are invited to visit our related page, Cryptocurrency Trading Research on Quantpedia. You can find it on the link will be included in this video, or you can subscribe to Quantpedia Premium and Pro, which also covers this asset class. We have nearly 50 strategies that are related to this asset class. So our previous research checked if there are possible seasonal effects in Bitcoin using hourly data from Gemini from 2015 until 2022. So we calculated hourly returns and we plot them into the chart. We can easily see that especially 2 hours that are specifically the returns for 2200 and 2300 UTC time seem to be the most economically significant. So those are the returns that we can see in this chart here. And on the other hand, the returns over the night 300 and 400 UTC time seem to be the worst. Now, what is the most interesting part is that those 2 hours, so hour starting 21 UTC ending 22 UTC and another hour starting 22 UTC ending 23 UTC, those are the other hours that all of the main exchanges are closed. So the seasonal effect or overnight effect in Bitcoin is mainly related to the liquidity. So that's the time when most main exchanges, main stock exchanges like New York Stock Exchange, London Stock Exchange, Frankfurt Stock Exchange, Sydney, Shanghai, Hong Kong, whatever. So all of the main exchanges are closed, and during this time there is significant return in a Bitcoin. But more of that is written in the previous article. In the following article, so in the article that we are now discussing, we move forward. So we check how the seasonal pattern changes over the different weekdays, Monday, Tuesday, Wednesday, etc. How the pattern change if we look at the current trend, so uptrend versus downtrend. So if there is a different pattern in uptrend than the downtrend. And how this pattern, so how this strategy holding Bitcoin during the 2 hours when there is the lowest liquidity, how does it work during the low volatility days and high volatility days. Firstly, what we did is that we extended the period of the backtest. So the backtest now ends not in 2022, but of course in June 2023. So we had more, 15 or 16 months of data. Once again, so we still see the same pattern with a longer data set. All of the main stock exchanges are closed at that time. So New York Stock Exchange, Tokyo, Hong Kong, India, Australia, London, continental Europe, etc. And during those 2 hours when all of the main stock exchanges are closed, there are significantly less professionals that are watching the market. So it means there is also lower efficiency in Bitcoin market, because a lot of the time the hedge fund managers, the managers who trade stocks and on major exchanges, they trade also the Bitcoin. So there are less people watching the Bitcoin, and there is a significantly positive performance on the Bitcoin. Here we have a longer sample of the strategy. So we see that strategy had a not very well or rough period in 2022 and 2023. It experienced a drawdown, but the strategy maximum drawdown over the last period, 22%, is quite an improvement if we compare it with the maximal drawdown of the underlying Bitcoin market. So this is the underlying Bitcoin market over the last 2 years. We see that we have over 70% drawdown in the worst point. Bitcoin is really far away from all-time high at the moment at $26,000 per Bitcoin. The strategy is close to all-time high. We are 10%, 5 or 10% in the drawdown. Strategy holds really well. It has the annualized rate of return 40%, Kalmar ratio 1.79. Even after 2 years or 1.5 years after the publishing, strategy holds really well if you compare it to the overall market. So let's take a look how does the pattern 21 UTC, 22 UTC up to 23 UTC look like when we control for the weekdays. We have multiple charts: Monday return, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday returns. Our analysis shows that the best performing days are Friday, Thursday, Saturday, Sunday. So the strategy of holding Bitcoins over the 2 hours at the end of the UTC day has a better performance over the weekdays and over the Fridays. Which are the days? I mean, Friday, 21 UTC, 22 UTC. I mean, that's the time when most of the portfolio managers that are looking for a way how to get into the closest or the nearest bar or nearest disco or go home, spend some time with the family. So it means that they don't have a time to watch what is the BTC market doing, and those are exactly the times when the Bitcoin performs well. So once again, performance is significantly better during the Friday, Saturday, and Sunday, and also the Thursday. Then we check market trends, so uptrend versus downtrend, and how does the performance over those two significant hours look like when we control for the market trend. Firstly, we computed the 10, 20, 50, and 200-day moving averages from daily bars. So it's entered daily bar on 00 UTC time. We calculated daily moving average from this time. And then we define the uptrend market if the Bitcoin price is higher than the moving average at 00 UTC time. And the downtrend market is if the price of the Bitcoin is lower than its moving average. And following this calculation, we define downtrend day as the next 24-hour period following the 00 UTC check of the Bitcoin trend. So if we check the trend at 00 and the trend shows that the price is under the moving average, so the next 24 hours we define as a downtrend. And if the price is over the moving average, then the next 24 hours we define as an uptrend. So in this case, we have a definition what is uptrend day and what is downtrend day. It's a definition that we can use for trading. How does the performance look like? So when you compare the performance over the downtrend and uptrend seasons, we can see that even visually performance of the strategy is significantly better during the uptrend. Here we have a chart of the same strategy. When we use the moving average as a filter, we see that the best performance and the lowest volatility can be obtained when we use the longer moving average to define the trends like 200 days. And last and the most interesting part is when we check for historical volatility. So we trade the seasonal strategy. We hold Bitcoin just for 2 hours, but before we enter the trade, we want to see if we are in a high volatility day or low volatility day. Once again, we perform the calculation at 00 UTC time. We use 30-day historical volatility, but we use the hourly performance bars. So we calculate the volatility from the hourly performance. And when we compare 30-day volatility to longer volatility, so to the median historical volatility over 1 year, so 365 days, this moving median serves as a benchmark. So we can define if the last 30 days were high volatility period or low volatility period. So we can divide periods into high and low volatility, and it's in the same case as the uptrend downtrend. So at the 00 UTC time, we check if the volatility of the last 30 days was higher than the median over the last year or lower than the median over the last year. If the volatility was lower, then the next 24-hour period is the low volatility period. If the volatility over the last 40 days was higher than over the median over the last 365 days, then the next 24-hour period we define as a high volatility period. And then we plot the chart. So how does the hourly BTC return over the next 24 hours look like? And we see clearly the difference. The performance during the high volatility days over the period from 21 UTC until 23 UTC is significantly better. So here we have a final strategy. We can hold the BTC or we can hold the Bitcoin between 21.00 and 23.00 UTC time only during high volatility days. In this case, we have nearly the same return. In this case, nearly 40%, so 47%. The maximum drawdown is minus 18%. The Kalman ratio is impressive, so it's a measure of risk-adjusted performance, and it's nearly 2. So the highest of all of the strategies that we presented in this article. The improved strategy is close to its all-time high. I mean, it's really impressive results. Thank you very much. I hope that you liked this video. I hope that you join me in the next one, and I hope that you subscribe to Quantpedia. It will help us a lot. Follow us on all of our social channels, check our website, and do not forget to subscribe to our YouTube channel. Thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.